Yes guys, today we're going to do VAT. VAT is that tax in this country that every single person pays on a daily basis. The current VAT rate is 15%, and we are going to talk how VAT is working. I want you to have a look at my work chapter 8, and there are specific exercises that I want you to focus on. One being examples 8.6 to 8.13, as well as exercise 8.3. Now that is the impact of VAT on your subsidiary journals, which is extremely important because I'm going to catch you out with that in the near future. Good, let's see what is the learning outcomes of this module. After this, you should understand the impact of VAT on the accounting process, and you have to be able to record all kinds of VAT transactions. Now, what is VAT? VAT is a tax that is levied on all kinds of transactions. So when you buy something, included in that purchase price is VAT. If you are a vendor and you're going to sell something, included in your selling price is VAT. Now, you provided that you are a VAT vendor. When you have to become a VAT vendor? So when do you have to register for VAT? You have to register for VAT when your turnover exceeds the threshold of 1 million rand. What is turnover? Turnover is sales. So it's not net profit. It is if your gross sales is 1 million rand or more, you have to register as a VAT vendor. If your turnover is less than 1 million rand, you can apply to become a VAT vendor with the Receiver of Revenue. Now, 10-15 years ago, they granted VAT vendorship fairly easy. Nowadays, they are quite picky with that. And the reason for that is you will see as we go along, you get something like that we call output tax, and that is money, VAT, that the entity has to pay over to the Receiver of Revenue. And then you get input tax, that is VAT that the entity can claim back from the Receiver of Revenue. Now, usually when an entity makes losses, it will also mean that his VAT input is higher than his VAT output. So he, on a constant basis, is receiving VAT back from the Receiver of Revenue. Now, we all know that the Receiver of Revenue's cash flow position is not all that good, and therefore, obviously, if he doesn't have to continuously pay VAT back, he is not going to register you for VAT vendor if he doesn't think that he's going to make some cash flow out of you. Now, let's see how that happens. What is VAT? A vendor must levy VAT at 15% on all transactions which is form part of the price, and that is called output tax. So, how I usually argue for myself is output tax is on sales. Sales is on merchandise that goes out of your shop. So therefore, output tax. So it is levied. I'm the entity that sells, let's say, furniture. On each piece of furniture that I'm selling, I have to levy VAT. And that furniture that I'm going to sell, whenever I'm going to sell it, that furniture is going to leave my shop. So therefore, it is going out of my shop. So that is output tax. Similarly, the Receiver of Revenue says, look, I'm a reasonable man. You have to pay me output tax on all your sales transactions. He says, but similarly, you can claim that back from me. So if you are going to sell a piece of furniture for 10,000 rand, you have to levy 1,000 rand, 15% VAT on that 150 rand worth of VAT. He says, but if that piece of furniture has costed you 8,000 rand, you didn't pay 8,000 rand, you paid 8,000 rand plus VAT for something. He says, and therefore, you can claim the VAT that you've paid on that piece of furniture back from me. So let me explain it to you by ways of an example. Let's say that we have a sales transaction and the selling price is going to be 1,000 rand. He says, well, That is what you are going to get in your pocket. But remember, you have to levy 15% VAT on all sales transactions. So therefore, you're going to levy 150 Rand worth of VAT. So what is going to be the total invoice price? So in other words, what is the customer going to pay for that merchandise that you're going to sell? The customer is not going to pay 1,000 Rand. The customer is going to pay your 1,000 Rand plus the 15% VAT on the 1,000 Rand of 150 Rand. So the customer is going to pay 1,150 Rand. You see, but that sales has costed you, that item has costed you, argument's sake, 600 Rand. He says, but you didn't pay 600 Rand for it. You also paid 15% VAT on that. That must be a plus, not equal. So the 15% VAT that you have paid on that item, which amounts to 90 Rand, means that you actually paid for that item an amount of 690 Rand. Now the question is, what is the profit that you've made? Guys, is it now 400 Rand, i.e. 1,000 less 600 Rand? Or is it now an amount of 1,150 Rand less 690 Rand equals 460 Rand? Now the answer is quite simple. That 15%, 150 Rand, does not belong to you. You had to levy it on your sales price, but then you actually was in a position of an agent of the receiver of revenue. You collected the 150 Rand as part and parcel of the selling price of the item. But only 1,000 Rand of that selling price, the invoice price, remember this is the invoice price. Only 1,000 Rand of the invoice price of 1,150 Rand belongs to you. The 150 Rand, which is the 15% VAT included in that amount, that you levied on my behalf and you have to pay it over to me. He said, but simultaneously, when you bought that item that you've sold, you didn't pay 600 Rand for the item, you paid 690 Rand for that item. That was the invoice price on the merchandise that you've purchased. But that invoice price included VAT of 90 Rand. So the amount that you can claim back from me now is 90 Rand for that item that you've sold. So your actual cost price, the amount that actually came out of your own back pocket, was only 600 Rand, not 690 Rand, because you can claim 90 Rand of that price back from me. So he says, well, now let's see. This VAT of 150 Rand was on the sales transaction that took place. Sales, the items went out of my shop, so that one there is output VAT. He says this 90 Rand is the amount that you paid on the items that you bought, and that items that you bought came into your shop, so that is input VAT. He says, and you can claim the input VAT against the output VAT that you have to pay over. So on this specific transaction, you are not going to pay over 150 Rand to me, but you're going to pay over to me the net amount after you have subtracted VAT. So you are only going to pay over an amount of 60 Rand. The output VAT is obviously more than the input VAT. So therefore, this is going to be a net output. And that's the reason why you have to pay it over to me, because you owe me on this transaction 60 Rand worth of VAT. How does VAT work? Let's have a look. The farmer plants corn and his input costs are 115,000 Rand. He sells the corn to the co-op for 126,500 Rand. The co-op sells the corn to the mill for 138,000 Rand, and the mill sells the grounded corn, the corn flour, to the consumer for 149,500 Rand. Now let's start with the farmer. He had input costs of 115,000, which included 15% VAT. So we have to take out the VAT. So his actual cost was only 100,000. 115,000 divided by 1.15. So the amount of VAT included in that was 15,000 Rand. 115,000 divided by 1.15 times 15% gives me an amount of 15,000. That was his input cost. That was cost that he incurred in order to grow the corn. So therefore, he can claim 15,000 from the receiver of revenue. He sold that same corn for 126,500 to the co-op. So what was included in that selling price? How much VAT was included in that selling price? So I take the 126,500, I remove the VAT, and I multiply that by the VAT rate of 15%, and I say, well, the output tax included in that amount equals 16,500. So the farmer has to pay output tax of 16,500, but against that, he can claim input tax of 15,000. So the net amount that the farmer is going to pay equals 1,500. Let's look at the co-op now. The purchase price of that corn for the co-op was 126,500. So how much was the VAT included in his costs? That was 16,500. He sold that corn to the mill for 138,000. So how much VAT was included in the selling price of 138,000? Well, it's 138,000 divided by 1.15 times 15%. That equals 18,000 Rand. So the co-op has to pay output tax of 18,000, but they can claim input tax of 16,500. So again, what is the net amount is going to pay the receiver of revenue? 1,500. Let's look at the mill. The mill bought that corn for 138,000 Rand. So what was the VAT included in the 138,000? 18,000 Rand. He sells the corn flour to the consumer of 149,500 Rand. So how much VAT is he going to claim, or how much VAT is he going to levy on the consumer? It's his selling price divided by 1.15 times 15%. So the VAT that he has to pay over, which he's going to claim from the consumer, equals 19,500 Rand. So the mill has to pay over output tax to the receiver of 19,500, but they can claim input tax on the cost of that flour of 18,000 Rand. So again, the mill has to pay over a net amount to the receiver of revenue of 1,500. So let's quickly add up. The farmer had to pay a net amount of 1,500. The co-op had to pay a net amount of 1,500, and the mill had to pay a net amount of 1,500. So 1,500 times 3 means that the receiver of revenue from this time where the farmer has planted the goods until it was finally sold to the consumer, there was a total amount of 4,500 Rand paid as VAT. Now let's check it. If you look at the original input cost of 115,000 Rand, what was the VAT exclusive amount of the input costs? 100,000. If you look at the eventual amount that they actually receive for that corn, how much did they receive eventually from the consumer? 149,500. If I take out the VAT, it gives me 130,000. So what was the profit realized if I look at the whole value chain? The whole value chain generated a profit of 30,000 Rand. What is the VAT applicable on 30,000 Rand? 30,000 times 15% equals 4,500 Rand. And that is exactly what the receiver of revenue received. But he didn't collect that only from the last mill. He actually collected it right through the process from different entities, from the farmer, from the co-op, and from the mill. Now, in the old days, before you were even a twinkle in your father's and mother's eyes, we had GST in this country, and there are very few countries in the world that still have a GST system in place and not a value-added tax system in place. And that is exactly what the GST system does. It only collects from the mill that 30,000 times 15%, i.e. 4,500. But if the mill is now a scallum, in other words, the mill is not going to pay the VAT because he is dishonest, it means that the receiver of revenue will nowhere collect anything on this transaction. He's going to lose out on the full 4,500 Rand. But with value added tax, if the mill was not all that honest, he still would have collected 1,500 Rand from the farmer. He still would have collected 1,500 Rand from the co-op. So in total, he would have collected 3,000 Rand, and he just missed out on the last 1,500. So because of the value chain being taxed, as the product is moving along, the receiver of revenue has a much bigger chance of collecting the VAT that is due to him. Now, you have seen in the previous slides when we actually talked about the accounting cycle and transactions, we spoke about invoices. And in one of those slides, I gave you examples of invoices. So I wanted to go back to that specific slide and just check what the invoice is looking at. Now that was all of them except for the cash register one was full tax invoices. Now if I'm going to sell an item which costs more than 5,000 Rand for that item, then I have to issue a full tax invoice to the person who's going to buy that from me. Now, what is the information that has to appear on this invoice? And guys, if you do not have all this information on your full tax invoice, you are subject to penalties and interest. Now, I worked for many years in a bank, and we were doing merchant banking, and we neglected to show all the information on our tax invoices. And we picked up a fine of 40 million Rand. Eventually, that fine was reduced, but with the new Tax Administration Act, which came into force last year, there is no opportunity of reducing fines anymore. Fines are all fixed, interest is all fixed, so that means that there would have been no ways to reduce that 40 million interest and penalties to something else. So that is how important this tax invoice is. The words tax invoice must appear on a prominent place. So you will see clearly in bold, in a bigger font, you will see the words tax invoice on top of the invoice. The name, address, and VAT registration number of the supplier must appear on the invoice. So if I've sold something to you, my name, address, and VAT registration number of the entity that I'm running, that must appear on the tax invoice. Then also on the tax invoice, your name and your address has to appear. You are the recipient now. That tax invoice must be pre-numbered, must be serial numbers, it must be pre-numbered, and it must be a printed number so that nobody can change it. So it must have a number on, and there must be a date of issue on the tax invoice. Then there must be an accurate description of the goods provided or services provided to you. The quantity or the volume of goods or services supplied must appear there. So I have sold to you 6 dining room chairs, and let's say we call them Supermoon. So I have sold to you 6 Supermoon dining room chairs. The price per chair must be there, so the unit price, and the total price of all the chairs must be there. The VAT must appear on the invoice. Now there are 3 approved methods for the VAT to appear on an invoice. If I've sold these 6 Supermoon dining room chairs at 1,000 Rand each to you, I could have said 6 times 1,000 equals 6,000 Rand. That is the VAT exclusive price. So I would have had 6 times 1,000, 6,000. I would have had a subtotal, 6,000 Rand. I would have said add 15% VAT on the 6,000, which gives me 900 Rand, and I would have total invoice value 6,900 Rand. Alternatively, I could have stated 6 Supermoon dining room chairs at 1,150 Rand each, VAT inclusive, times 6 would have given me a total VAT inclusive amount 6,900 Rand. Or I could have said to you, I've sold to you 6 Supermoon dining room chairs of 1,150 Rand each, 6,900, and then a small sentence can appear at the bottom of this invoice. Included in the above amount of 6,900 Rand equals VAT of 15% or equals a VAT amount of 900 Rand. So any one of those three methods is approved by the receiver of revenue. Now, if that item was sold to another VAT vendor, so if I sold this dining room chairs to you and you are also a VAT vendor, in other words, you're also registered for VAT, your VAT number must also appear on that invoice. Remember, you're going to get the original invoice because you are the client. Now, if you are a VAT vendor, you are going to claim the VAT from the receiver of revenue. You can only claim the VAT from the receiver of revenue if you have a VAT invoice and if your VAT number appears on that VAT invoice. Otherwise, you cannot claim the VAT. So that is why it's so extremely important. We also get an abridged tax invoice. Now, go and have a look. The slip that you receive from Pick n Pay, Spar, or Checkers, or one of those shops, any shop, is an abridged tax invoice. Now, scratch around in your room. I'm sure somewhere you're going to find a slip, or somewhere in the house you're going to find a slip, or next time when you go to the shop, retain the slip and check the particulars on the slip. I'm sure you're going to do that for the first time in your life. You will see that the words tax invoice appears on that slip in a prominent place. You will see that the name, address, and VAT registration number of Pick n Pay, Spar, whoever appears on that little slip. You will see that that slip has a serial number, pre-printed, and you will see that that slip has a date of issue. You will see that on the slip, there's quite an accurate description of the goods that you've purchased from Pick n Pay, Spar, whoever. And you see that the price and the VAT of the items purchased will appear on that slip in any way of the three approved methods. So either a VAT exclusive amount plus VAT 15% equals total amount, or a VAT inclusive amount, or you can have included in this amount of whatever the price was VAT of X amount. So either one of the three is acceptable to the receiver of revenue. Now, all prices quoted on the shelves of any retailer must include VAT. You will see that in some questions we will refer to the invoice price. The invoice price always includes VAT. Or the shelf price always includes VAT. Or the listed price, and the listed price always include VAT. I'm not going to tell you that. You must know that. It is extremely important because in accounting, before you can do anything with anything, you have to remove the VAT. Most transactions are subject to a VAT rate of 15%. Now, these transactions are called standard rated transactions. Guys, now what transactions are not subject to VAT and what do we call them? Now, there are certain items which is zero rated transactions. Now, it's important that you realize that there is VAT applicable on those items, but the VAT rate equals 0. So you do not claim any VAT and you do not pay any VAT on those kind of transactions, but there is VAT applicable on those kind of transactions. Then you get exempt transactions. Now there's no VAT applicable on those kind of transactions at all. Why then the distinction? Why is it so important that I distinguish between zero-rated transactions and exempt transactions? Guys, you can only claim VAT on VATable items. So the receiver of revenue will allow you to claim VAT if eventually it is applicable on something that he calls a taxable supply. Now, a taxable supply means that you are going to levy VAT on that sales and eventually you're going to pay over the VAT to the receiver of revenue. So you can only claim VAT to the extent that you are going to incur a VATable supply income. So there's going to be VAT applicable to that you're going to pay over to the receiver of revenue. Now, a zero-rated item means that there is VAT applicable on certain items. The rate is just zero. So if you have incurred costs in order to generate a zero-rated income, then it means that you can claim the VAT input on those transactions. But if you have incurred certain costs, VAT inclusive, for an exempt transaction, an exempt transaction is not subject to VAT, so the receiver of revenue can never get VAT on that transaction. Then he says, to the extent that you've incurred costs and VAT was included in those costs to generate exempt transaction type of revenue, you will not be allowed to claim the VAT input on those transactions. Now, we're not going to get that technical this year. We will, however, in the next year and when in tax, especially when you're going to have tax as a subject, you will have a lot of transactions which you have to make the distinction. So let's have a look at examples of zero-rated transactions. Fuel, petrol, diesel, and paraffin. There is no VAT on that. It's a zero-rated transaction, so it's subject to VAT, but the VAT rate is zero. Now, there's a lot of other levies included in these prices, but it ain't VAT. So there's no VAT on those items. Then basic foodstuffs, and look at the word basic. It really means basic. Brown bread, but not your sliced Sasco, Blue Ribbon, Albany breads. That's fancy bread. That is subject to VAT. But this old common bread, brown bread that your supermarket is baking there in the ovens, which is just coming the no-name bread. Let me call them no-name bread. Now, there, no VAT is applicable on the brown bread version. But on the white bread version that the bakery is actually producing on a daily basis, there's VAT on because white bread is a luxury item. Brown bread is a necessity. Therefore, there's VAT on white bread, but not on your common variety brown bread. Vegetables, but only fresh vegetables. Frozen vegetables or any processed vegetables, there's VAT applicable on those vegetables. Fresh fruit, no VAT, but as soon as you've done something with it, then there's VAT. Milk, but now again, fresh milk. As soon as you get to this long life milk and those kind of fancy milks, there's VAT applicable on those items, but fresh from the cow, there's no VAT applicable on that milk items. Rice, eggs, maize meal, dried beans or mealies or peas, there's no VAT applicable on that. And then I think sanitary towels has also been added to this list as a zero-rated item. When I export goods to somewhere outside the borders of South Africa, remember the guy on that side, it's got nothing to do with our VAT system on this side. So therefore, when I export goods, I cannot levy a VAT on those goods that I'm going to export. So exports are a zero-rated transaction. Examples of exempt transactions. Now, non-fee driven services is exempt from VAT. Now, what is that? That basically non-fee driven services is interest income. So interest income, dividend income is not subject to VAT. But fee-driven services, fee-based financial services such as bank charges or any other fees that the bank is levying on its clients, that is actually subject to VAT. So interest and dividends is not subject to VAT, but fee-driven services are subject to VAT. Educational services is an exempt transaction. Look at your varsity account that you must have received already. There's no VAT on the educational services, so that's an exempt item. Now, transport costs is an interesting one. Passenger transport via road or rail is exempt from VAT. So if you get in a car, there's no VAT. If you get on a bus, there's no VAT. But heaven forbid of getting on an aeroplane, because on an aeroplane, that's fancy dancy stuff. There's VAT applicable on your flight ticket. The letting of residential property. Guys, what is residential property? That is where you stay. You are renting a room or flat or something close to the campus, and because you stay there, there's no VAT applicable on your monthly rent. But as soon as you rent premises for business purposes, there's VAT applicable on that rent. So rent on premises that is used for business purposes is subject to VAT. It's only if it's residential, and i.e. you stay there. It is your home. You're going to rent premises to be used as your home. That is not subject to VAT. Salaries and wages, not subject to VAT. Let's look at an example for output tax. A vendor sells goods for 115 Rand cash, inclusive of VAT. Obviously, you're going to receive 115 Rand, so bank will be debited. Sales income would be credited with 100 Rand, the VAT exclusive amount. So what will be recognized as our income? What will have an impact on our profit figure at the end of the year? Only the VAT exclusive amount, because we are only entitled on the amount before VAT. The entity is just acting as an agent on behalf of the receiver of revenue, what VAT is concerned. He actually collects the VAT on sales transactions, output VAT, and then he claims VAT on costs, that is input VAT, from the receiver. So the cost is the VAT exclusive cost because he can claim the VAT portion of that cost back. So it's not for his own pocket. The sales, you can only recognize the VAT exclusive amount because, again, the VAT portion on that sales transaction, he collected the VAT on behalf of the receiver of revenue, does not belong to him. Input tax. When a vendor purchases goods or services from another vendor and there's VAT on the transaction, the purchaser can claim the VAT. So now here, I must be a VAT vendor in order to claim VAT back from source. And then obviously, I need a VAT invoice to claim the VAT back from source. So that means you can only issue VAT invoices. Only VAT vendors can issue a VAT invoice. So if I want to claim VAT back from the receiver of revenue, I must buy the goods from another VAT vendor. So if I receive a VAT invoice from a supplier or a provider of a service or whatever, if I receive a VAT invoice and I'm a VAT vendor, I can claim the VAT from the receiver of revenue, and that is what we call input tax. A vendor purchases goods for 69 Rand worth of cash, so inventory will be debited with a VAT exclusive price, 60 Rand. Input VAT, 9 Rand included in that amount that I've paid, that I can claim from the receiver of revenue, and then bank would be credited with the actual amount that I paid. I paid 69 Rand, so my bank will be credited with 69 Rand. Good, so what at the end, now this input and output, obviously you are not going to settle this bill with the receiver of revenue each and every time that a transaction takes place. There is a VAT period. Now, if I'm a medium or small sized entity, the VAT period is a 2-month period. If I am a fairly large company, I have to pay VAT monthly. On the 25th of the month, I have to pay my net VAT to the receiver of revenue, or if I'm a small or medium-sized entity, every 2 months on the 25th of that month, I have to pay over VAT to the receiver of revenue, or claim net VAT back. So how do I do that? For that whole VAT period, I accumulate all the input VAT in my VAT input account, and I accumulate all my output VAT in my VAT output account. At the end of this VAT period, I will transfer the balance of the VAT input account to my VAT control account, and I will transfer the balance of the VAT output account to my VAT control account. So I clean out the VAT input account and I clean out the VAT output account at the end of the VAT period, being it a month or being it a 2-month period. So in my VAT control account on the credit side, I will have total VAT output for that period. And on the debit side, I will have total VAT input for that period. And then I'm going to balance off the VAT control account. So if the VAT control account's got a credit balance, what does it mean? It's a liability. It means that my output VAT was more than my input VAT, and I have to pay over to the receiver of revenue whatever the balance is. If I end up in my VAT control account with a debit balance, what does that mean? That means that my VAT input was more than my VAT output. So that net amount of the balance, the receiver of revenue has to give me my money back. So he owes me money, debit balance, asset account in my statement of financial position. So let's do an example. Let's say at month end, the output and input accounts are transferred to a VAT control account to determine the amount payable to SARS. So if we take our same example that we had here we had output VAT of 15 Rand and we had input VAT of 9 Rand. So the 15 Rand was a credit balance here in my output account. So in order to get rid of it, I would have debited VAT output, 15 Rand. I would have credited the VAT control account, 15 Rand. For here, I had debited VAT input initially, so if I want to get rid of it, I am going to credit my VAT input account and I'm going to debit my VAT control account. So what is going to be the net amount left in my VAT control account? It's going to be 15 minus 9, a credit balance of 6 Rand. So now I owe the receiver of revenue the net amount of 6 Rand. I'm going to pay him that, credit bank 6 Rand. I'm going to debit my VAT control account with 6 Rand. Then the balance on my VAT control account is going to become 0. If you are late in making any VAT payments to the receiver of revenue, it needs to be paid on the 25th of the month that your VAT period is ending, and you have to pay that before 12 o'clock that evening. If you are late, you are paying interest and penalties from 1 minute past 12 on that specific date of the 25th until the date that you're going to settle the bill. They don't want to listen to your excuses. They are very unsympathetic and they are definitely raising interest and levies without any exemption from any kind. Now, if a levy and interest is actually interest or levies penalties is levied on you, what is the accounting entry? I'm going to debit an expense account, penalties and interest, and I'm going to credit the VAT control account, which is a liability account, with the amount of penalties and interest levied on me. Let's do another example. A small retailer purchases goods from a wholesaler for 13,800 Rand, VAT inclusive, for cash. He then sells the goods to J Public for 16,100 Rand, VAT inclusive, also for cash. He uses the perpetual inventory system. So he wants you to do the record the purchase and sales transactions and do the month-end closing of the VAT accounts. So the first thing that we've done is let's do the calculations. They bought goods for 13,800 and the second transaction they sold that same goods that they bought for 16,100. Oh yeah. Purchases. 13,800, but it includes VAT. So we have to remove the VAT. Guys, that's always your first step, remove the VAT. So the VAT exclusive purchase price was 12,000 Rand. What is going to be our accounting entry? We're going to debit trading inventory account with a 12,000 Rand. We're going to debit our VAT input account with 12,000 times 15%, which is 1,800. And we're going to credit bank with the invoice amount of 13,800. Then we've sold these goods. We've sold these goods for 16,100 Rand. We take out the VAT, first step. So the VAT exclusive selling price was 14,000 Rand. How much did we receive? We received the invoice amount of 16,100. So bank debit, 16,100. What is our revenue that we realized? We only realized 14,000 Rand worth of revenue, the VAT exclusive amount. 14,000 times 15% is the amount included in that 16,100 that we owe the receiver of revenue. So VAT output credit, 2,100 Rand. It is a perpetual inventory system, so we have to adjust our inventory record. Obviously, we don't have that 12,000 Rand inventory anymore, so we want to credit that amount with 12,000 Rand against our inventory account. And what does it represent? It represents cost of sales debit 12,000 Rand. Here again, this is just one of the journals affected by VAT. I want you to have a look at examples 8.6 to 8.13 in your textbook, chapter 8, as well as exercise 8.3. That is extremely important.